Business involves starting a company because company gives a face to the business. So if you would like to carry on with your company in a more structured way, if you are looking for a scalability in your business and accordingly you want to plan for the business face formation or the company formation, then this is the video for you. So it is important for you to watch this till the end as we are taking up the private limited company formation, the most preferred way of company formation in this video. This is Abhishek Sengupta and welcome back. We are on with our business series, and in this particular series we have taken up the company formation. We have already discussed about the company formation, the importance of company formation, the pros and cons of the company formation. We have also discussed about the unregistered company, proprietorship company and traditional partnership company. If you would like to see the other videos of this series, simply click on the I button above and check that. If you would like to see the previous videos of this series, wherein I describe the proprietorship and the traditional partnership companies, simply go to the description of this video and click on the links given. Now in this episode, we are taking up the topic of private limited company. Private limited company is the most popular way of starting a business because in this type of company, the business is registered and scope of scalability is quite huge. It also makes the credibility for the business and it is also liked by the investors. So let's see what this type of company is all about. Private limited company is the business registered by private entities. As per Company Act 2013, minimum 2 people are required for registering this type of company. In this type of company, a group of people become the founder of the company as they registered the company and they become the directors of the company. The total capital is the share withheld by the directors of the company. Here, the liability of the members are limited to the shares withheld by that member of the company. In this type of company, the personal assets and the business assets are treated separately. The shares of this type of company cannot be traded publicly. Now, this is also called privately held companies in few countries. This is because these are non-government entities and the shares of the companies are held by a group of people. Rules governing these type of companies varies from country to country. Just for example, in United States of America, the privately held companies do not need to publish their financial statements. Whereas in European countries, it is just the opposite. Now, different countries have different names for such kind of entities. In United States of America, it can be termed as limited liability company or privately held company and can be abbreviated as LLC or PHC. In UK, Ireland and Hong Kong, this is named as private limited by shares and can be abbreviated as LTD. In India, in Nepal and in Bangladesh, it is referred as private limited company and it is abbreviated as PVT Ltd. In Belgium, in France and in Switzerland, it is termed as Société à Responsabilité Limitée and it is abbreviated as SRL or SARL. In Austria and Germany, this is referred as Gesellschaft mit Beschränkter Haftung and it is abbreviated as GmbH. In Australia, these are referred as Proprietary Company Limited and abbreviated as Pty Limited. In Singapore, these are referred as Private Limited by Shares and abbreviated as Pty Limited. In New Zealand, these are referred as Limited Liabilities Companies and abbreviated as LTD. A private limited company is further classified into 3 types of companies. Number 1 is private limited by shares, private limited by guarantee an unlimited company. Private limited by shares. The liability of the members are limited by memorandum of association to the normal amount of his or her share, or so much so which remains unpaid. So the liability of the members or the founders with respect of this type of private limited company is restricted to the paid up capital or any amount which remains unpaid. A shareholder cannot be asked to pay more than his share capital invested in the company. Second is private limited company by guarantee. In this type of private limited company, the liability of a member is limited to the guarantee given by each member in the Memorandum of Association. In this type of company, the founding members or the members or the directors cannot be held liable for the amount higher than the guarantee given in the Memorandum of Association at the time of formation of the company. Now, this type of company is suitable for clubs, for societies, or for associations. Number 3, the unlimited companies. Now, this type of company is a bit interesting. In this type of companies, there is no limit on liability on its members. The liability on each member is equivalent to the liability and debt of the company as a whole. Here, the debt of the company can be enforced on its shareholders, directors, or founding members. Despite not giving any liability protection, still in this type of company is treated as a separate entity from its directors or shareholders. Let me take up 2 more terms related to this type of companies. Number 1 is Memorandum of Association and number 2 is Article of Association. Let us first discuss the Memorandum of Association. Memorandum of Association is actually the charter of the company. This is a legal document prepared during the formation of the company. This mentions company's objective, description of business and its relationship with its stakeholders. Company can undertake only those activities which are mentioned in the Memorandum of Association. In other words, it defines the boundary for operation of the business entity. This helps anyone to know about its company, type of business, mode of operation, its stakeholders, and other relevant details. Memorandum of Association includes 5 clauses. Number 1 is name clause. Name clause defines the name of the company and the type of the company. Number 2 is registered office clause. Now, registered office defines the address of the company. This defines the jurisdiction of registered of company for that particular company. At times, the address is not mentioned. So in that case, after formation of the company, within a stipulated period of time, one has to inform the address of the company to the registering authority or the registrar of company, also known as ROC. Number 3 is objective clause. Now this defines the objective with which the company is born or company is made. Number 4 is liability clause. Now this liability clause mentions and defines the liability of the company. Number 5 is capital clause. This mentions the maximum capital one company can raise. This comes in form of authorized capital. It also explains and describes about the capital distribution amongst the stakeholders. Next, let us discuss the Article of Association. Article of Association is a document which describes the rules of an operating company and its intent. This describes how activity inside the company must be performed. This mentions the manner in which the company can issue its share, pay dividend, audit financial records, and offer voting rights. Article of Association or AOA is quite similar across the globe, but exact term varies from country to country depending on the laws of the land. 2 more concepts are quite important in this. One is paid up capital and number 2 is authorized capital. Now, what is paid up capital? Paid up capital is the amount of money for which the shares of the companies were issued to the shareholders or founders. And the payment of this amount is made by the shareholders. Generally, this payment has to be done within 6 months from the formation of the company. The directors have to pay this money and this goes to the bank account of the company. Based on this money, the commencement certificate is issued to the company. Number 2 is authorized capital. This is the maximum amount of capital for which shares can be issued by the company to the shareholders. Now, this is mentioned in the Memorandum of Association under the capital column. Now, let us discuss the advantages and disadvantages of a private limited company. Number 1, let's go for advantages. Number 1 advantages is it is a registered company. Number 2, the details of the private limited company can be checked online. Number 3, it falls under compliance as laid by the government of the country. Number 4, it increases credibility of the company. Number 5, it is easy to go for the fundraising exercise. Number 6, the scope of scalability is quite huge in this kind of companies. Number 7, there is a provision of adding co-founders in the company. Number 8, it is liked by the investors. Now let us discuss the disadvantages of the private limited company. Number 1, the forming the company is an expensive process. Number 2, the processes for formation and other processes of the company are time consuming ones. Number 3, it requires a lot of paperwork. Number 4, there are a lot of compliances on this type of companies. In spite of so many advantages and disadvantages, private limited company is the most preferred way of doing business across the globe. This has its own advantages and disadvantage, but if we compare advantage and disadvantage, the share of advantage is quite huge. Apart from that, as I have already mentioned, the scalability provision is also quite huge in this type of company. The fundraising exercise is quite easy and it is also liked by the investors. That's all for today. If you have any question, please write in the comment section below. I'll check and answer it as soon as possible, or you can even ping me in my social media profile. Link for that is given. And if you got benefited from this video, subscribe to the channel, like and share this video. I'll be back with many such videos. Till then, stay tuned, stay connected, and have a great day.